Hi, my name is Christopher Joy. I'm CIO of Coolabah Capital. Today I'm going to talk to you about our active composite bond strategy, which is a long duration strategy, currently paying a running yield of 6.4% per annum, and our Coolabah floating rate high yield fund, which is a zero duration or floating rate strategy that is currently paying a cash running yield of 8.9% per annum. A little bit more about Coolabah. We set up the business in 2011 as an active credit trading specialist. Coolabah today is probably the most active trader of Aussie and New Zealand bonds globally. Since 1 January last year, we have bought and sold over $100 billion worth of bonds and credit. So this spans government bonds, state government bonds, corporate bonds, bank bonds, and episodically ABS and RMBS. We're very active in the Aussie credit market, in the European credit market, and in the US credit market. That activity requires a large team. We're typically trading 50 to 100 times a day. We're typically turning over $300 to $400 million a day. Even in very stressful markets and liquid markets comparatively, like we saw in 2022, we were typically trading 4 to 5 billion a month. We use 30 to 40 proprietary bond valuation models, which we've built in-house, to revalue live every security globally that we trade. We also use artificial intelligence that we have developed internally to rate live every bond issuer globally. And we're hunting for mispricings. Our main mission is to try and find cheap bonds that are paying too much interest for their risk factors, and we want to accumulate those assets and watch the interest rate normalize or mean revert, and then in exchange we capture capital gains. So as you can see on this slide, what we're showing here is the black dots are all bond sales that we've effected over the last decade plus, and the vertical axis are the returns on the bond sales. And we're generally winning or making positive total returns more than 90% of the time, and similarly we're capturing positive capital gains more than 80% of the time. And we are typically more than doubling the yield on the portfolio with the capital gains we're generating through finding cheap, mispriced bonds that are paying too much interest for their risk factors. Now this approach is very different to the conventional fixed income paradigm for bond fund managers. Normally, bond managers are going to give you portfolios of 500 to many thousands of individual bonds. They're going to claim they're well diversified. We think that often they're diversifying mindlessly into risk. We've seen recently that many fund managers held Credit Suisse hybrids which were wiped out. Similarly, in the March 2020 period, many fund managers held Virgin senior bonds which were wiped out. We were shorting Credit Suisse senior bonds in 2022, and we were advising our clients to exit Credit Suisse exposures in early 2021. So as I mentioned, this requires a large team, and we have 38 staff in total, which we are continuing to grow. Those executives are based in London, Sydney and Melbourne. We have 12 traders and portfolio managers, 12 to 14 analysts, and a very large finance ops and a risk team. We have what we call a quantum mental investment process. This uses top-down statistical models and bottom-up statistical models to revalue all bonds globally. As I mentioned, we use artificial intelligence to rate every bond globally. We also have a very large credit research team that evaluates all issuers globally that we cover, so hundreds of individual names. Those analysts are based both in Australia and overseas. We do a lot of market technicals analysis to look at the supply and demand side flows in the market, and we do a lot of macroeconomic research. Turning to the portfolios and returns, recent returns across all of our strategies have been incredibly strong. Of late. These are the 6-month returns. The black bars are our strategies, the red bars are benchmarks. Our long-short credit fund has done about 9.6% net of fees over the last 6 months. The active composite bond strategy that I'm going to talk about today has returned about 7.9% net of fees over the last 6 months. And our new floating rate high yield fund was launched in early December and does not feature here. The key facet we're trying to capitalize on is unusually elevated interest rates on bank bonds and cash vis-a-vis alternatives. So bank senior bonds from the major banks are paying about 5% interest Cash is paying 4 to 5%. Government bonds are paying anywhere from 3 to 5%. And bank tier 2 bonds are paying interest of 6 to 7%. As you can see on this slide, in comparison, residential property is paying about 4%, which is really unattractive. Commercial real estate's paying 4 to 5%, but even equities is paying, with the benefit of franking credits, only about 6%, be that bank stocks or the overall equity market. The Coolabah Floating Rate High Yield Fund is currently paying 8.9%. This is a floating rate portfolio of Australian bonds, primarily Aussie bank bonds. 80% of the portfolio is the 4 major banks currently. The rest is Bendigo, BOQ, Suncorp and Macquarie. And we only invest in their senior ranking bonds and their tier 2 bonds. This strategy can't invest in hybrids, equities or junk bonds or private credit or much riskier loans. It can use gearing of up to 75% to enhance the yields on the portfolio, which we do, and that gearing is low cost. The average credit rating in the portfolio today is A-, and the portfolio has daily liquidity. It has no performance fee. All the fees are captured inside a single management fee of between 80 and 100 basis points. In the chart here, you can see the gross cash running yield, which is 8.91%. This is the annual interest rate we're earning in the portfolio right now, and that compares very well to equities, hybrids, bank bonds, and even global high yield. The point about the Coolabah Floating Rate High Yield Fund is that it's providing you a high yield return without default risk and without significant liquidity risk. Now, obviously, there are always risks associated with all investments, but we would contend that the default risk on the major bank senior bonds and tier 2 bonds is very modest in comparison to the default risk that you'd find in high yield bonds, sub-investment grade issuers, in small corporate loans and so forth. So low default risk, strong liquidity, a very high yield. We do use gearing, which will amplify both the upside and downside. In terms of the volatility of the portfolio, this sort of strategy over the last decade would have had volatility similar to the major bank hybrid market on the ASX. It also would have had volatility similar to the global high yield bond market. But basically, it's returned, looking at 75% geared Aussie bank bonds, about 7.1% per annum with about 5% volatility. And it's basically given you 80% of the return of equities, as proxied by the All Ordinaries Index, with about a third of the volatility of equities. Equities have about 15% per annum volatility. The other strategy I wanted to quickly finish off and talk about is our Coolabah Active Composite Bond strategy. This gives you a fixed exposure to duration of about 5.5 years. The duration in the portfolio is the same as the Composite Bond Index. That's represented by the red bar in this chart. The chart shows since inception returns since the launch of the strategy in March 2017 for a super fund. The super fund did a global search. They looked at 157 different fund managers. They had the advice of B Finance, a global asset consulting firm, and they selected Coolabah. We hadn't actually run a long duration strategy before. We were specialists in floating rate strategies, but they asked us to overlay an index duration exposure. So we take the Composite Bond Index duration and we fix that. We are not trying to second guess the direction of interest rates. We are instead really focusing on active individual asset selection. So this is a very active portfolio with exposure to Commonwealth government bonds, state government bonds, bank bonds, and corporate bonds in Aussie dollars, US dollars and euros, all hedged back to Aussie dollars. It's very active, as represented by the fact that our turnover will be as much as 5 to 7 times a year in terms of overall portfolio turnover. But this strategy has beaten the Composite Bond Index after retail fees since inception. So we're the blue bar. It's available in ETF format. The ticker is FIXD. So the Active Composite Bond strategy is available on Chi-X under the ticker FIXD. It's beaten the Composite Bond Index, and it's also beaten all peers over virtually all horizons. So whether we look at it over since inception, 5 years or 3 years, we are number one. And what's also important is that compared to the index, we have superior risk-adjusted returns. Specifically, if we look at our rolling Sharpe ratio, the strategy is the blue line, the index, the Composite Bond Index is the red line on the left-hand side on this chart. We've had a higher Sharpe ratio or risk-adjusted return than the index since inception. That Sharpe ratio is our return above cash divided by the fund's volatility. On the right-hand side is something called a Sortino ratio. That is the fund's return above cash divided by our downside volatility. And again, we've had a superior risk-adjusted return to the index since inception. And then the chart on the right-hand side here, called the Kalmar ratio, is the return above cash divided by our worst loss. And again, the active composite bond strategy has outperformed the index both in raw excess returns after retail fees consistently over all intervals, but also it's displayed substantially superior risk-adjusted returns, whether we use Sharpe ratios, Sortino ratios, or Kalmar ratios. Significantly, when we load in all the peers into this universe, we also have higher risk-adjusted returns than all peers that we're aware of since inception. Right now, clients believe that there is a role for duration in portfolios because government bond yields have increased from about 1% to as much as 4 to 5%. We've seen overnight cash rates controlled by central banks increase from close to 0% to 4, 5+%. And fixed rate bonds tend to perform well in recessionary environments when interest rates are falling. And we're seeing the inversion in yield curves globally as long-term interest rates are now lower than short-term interest rates. And we've seen very strong returns from our active composite bond strategy, which has delivered almost 8% over the last 6 months, reflecting the performance of duration. If you'd like to find out more about Coolabah strategies, you can go to our website, which is coolabahcapital.com. You can follow me on Twitter at CJOYE, or you can go to my Livewire page where we publish all of our research, which is disseminated weekly.